Costco makes almost no money on what it sells. The $600 billion retail giant that moves everything from televisions to toilet paper operates on product margins that often sit around 10 to 12%. In some categories, the net profit after expenses is barely there. Yet the company consistently produces billions in operating income and some of the strongest returns in retail. That shouldn't add up. If the products aren't generating meaningful profit, where is the money coming from? From the outside, Costco looks like a volume machine. Massive warehouses, pallets stacked high, carts filled to the edge. The assumption is simple. Sell more units, earn more profit. But Costco's engine does not depend on merchandise margins. It depends on something else. Traditional retailers make money by marking goods up. They buy low, sell higher, and the spread covers labor, rent, logistics, and shrink. The wider the margin, the more flexibility the business has. Costco deliberately narrows that spread. The company caps markups on branded products at roughly 14%, and often keeps its private label Kirkland items even tighter. Many retailers mark goods up 25, 30, even 50%, depending on the category. Costco chooses not to. That is not generosity, it is design. Lower markups compress short-term product profit, but they build price credibility. Members learn that Costco prices are consistently lower than competitors. That credibility compounds over time, and credibility changes behavior. Customers stop comparing every item. They assume efficiency. They buy in bulk. They renew memberships without re-evaluating the math each year. Costco trades margin for loyalty, but loyalty alone does not explain the income statement. The shift becomes obvious when you compare operating income to membership revenue. In many fiscal years, Costco's total net income is roughly equal to its membership fees. Sometimes it is even lower. The merchandise business largely covers operating costs. The membership fees drive the profit. That reverses the retail model. The warehouses justify the membership, the goods support the fee. The recurring revenue produces the earnings. This structure changes incentives. Because profit does not depend on squeezing suppliers for maximum markup, Costco can focus on price leadership. Lower prices increase perceived value. Higher perceived value supports renewal rates. Renewal rates stabilize recurring revenue. More than 90% of Costco members renew annually in the US and Canada. That level of retention is rare in discretionary retail. It resembles a subscription platform more than a store. Costco does not think like a traditional retailer. It thinks like a membership business. When profit comes from recurring fees, the focus shifts from transaction margin to lifetime value. Time horizon changes. Most retailers optimize quarterly gross margin. Costco optimizes multi-year retention. That difference shapes the entire system. Consider the limited SKU count. A typical Costco warehouse carries around 3,800 active items. A traditional supermarket might stock 30,000 to 40,000. Fewer items mean higher volume per SKU. Higher volume improves negotiating leverage. Better wholesale pricing supports lower markups. A constraint becomes an advantage. Simplifying assortment increases inventory velocity. Faster turnover reduces working capital tied up in stock. Lower carrying costs reinforce the low price promise. Each piece supports the next. The psychology matters as well. An upfront membership fee creates a sunk cost. People are more likely to use something they have already paid for. The fee increases visit frequency. More visits increase basket size. Larger baskets reinforce the value of membership. The fee is not just revenue, it shapes demand. This dynamic becomes more visible during downturns. When budgets tighten, consumers gravitate toward perceived value leaders. Costco's reputation as a low-margin operator strengthens its appeal. Membership revenue remains relatively stable. Merchandise margins stay thin, but volume holds. The company sacrifices per-item profit to build long-term resilience, and the model is difficult to copy. Competitors cannot simply lower prices to match Costco without compressing their own margins. Without a large recurring membership base, price cuts immediately erode profit. Costco can sustain thin margins because the fee absorbs volatility. That structural cushion is the advantage. Even the private label strategy reinforces it. Kirkland products often match national brands in quality while maintaining tight pricing. Because Costco does not rely on wide markups, it can prioritize value over brand premium. Membership revenue provides stability. Stability allows discipline. Now, imagine Costco raised product margins meaningfully. Prices would rise. The value perception would weaken. Renewal rates would decline. The recurring revenue engine would slow. Short-term gross margin might improve. Long-term profitability would likely fall. The trade-off is clear. Costco is not maximizing profit per transaction. It is maximizing profit per member. From a distance, it appears to be a high-volume retailer operating on razor-thin margins. In reality, it functions like a subscription business wrapped in a warehouse format. The goods justify the fee. The fee justifies the low prices. The low prices justify the loyalty. The system reinforces itself. So it is technically accurate to say Costco makes almost no money on what it sells, but that observation misses the larger design. The merchandise is not the profit center, it is the retention mechanism. Costco's real product is access. Access to disciplined pricing, access to curated inventory, access to a structure built around long-term trust instead of short-term markup. The pallets in those concrete warehouses are not where the margin lives. They are where the promise is delivered. The margin lives in the membership.